And welcome to another edition of the Nerdy Agent Podcast. I'm your host, Luke Pedersen, with my brothers and fellow nerds, Josh and AJ. My mic is really high today. I feel like I'm trying to tower. It's taller than all of us. Well, I'm not. I'd technically be shorter on the blogs. It's high up here. Today we're going to get into the Fed, the overnight lending rate, the 30-year mortgages, and then talk about what our outlook is and what the people are saying, give some insights in that. To start, Josh told us he had a fun fact, and I didn't want he had a fun fact. I wanted to start the podcast with it, opposed to doing it off podcast, because we are notorious for having conversations right before starting the podcast, and I really think that a little bit at the beginning is fun.
Yeah, well, I mean, we listen to all sorts of different things and study different things, and we're interested in all sorts of different things. So I've been listening to specific podcasts the last week about, if you've ever listened to the Acquired podcast, you should listen to the Acquired podcast after you finish the Nerdy Agent podcast. But there was a discussion today on that one about a technology that came out in 2009, right? So this is only like 15 years ago, not that long ago.
16.
Yeah, that absolutely upended everyone's world. Like, when it was released, it was such a big deal that everyone freaked out about it in 2009. Do you know what it was?
I have no idea. Wait. Google Maps.
Close. Google Maps existed before.
Sorry, Apple Maps.
2009 is when they first released turn-by-turn navigation from a phone.
Yeah, that's a pretty good guess.
That's a really good guess. Do you remember this? They used to have TomToms that they used to have remember those little things that you put on your dashboard? Remember?
Yeah, ever? Okay, favorite story. Google Maps existed like I
existed. You were ever
didn't allow you when you were driving.
2009 is when the Droid launched. And when the Droid launched, it used Google Maps' software to do turn-by-turn navigation. At that point in time, Apple's turn-by-turn, you had to click like, I made that turn, and it was in your next.
Oh, okay, yeah.
This is like 50. This is in the Crescent. It's like years ago.
Yeah. Luke, were you in the car? That was when you got. I was 15. Well, I guess.
I had graduated college.
I have a great story. Were you in the car when Dad first saw a Garmin do navigation? I was not. Oh, well, me and Josh were.
Oh, yeah.
And Josh was looking at the Garmin, and he knew about technology, and he was like, Dad, it's going to tell us where to go. And Dad is notorious for like, I know I'm going north or south or east or west, and I know where I'm going. And he was like, no, I got to go this way. And Josh was like, yeah, the Garmin says we should go this way. And he's like, nope, we're going this way. And then Dad got lost. And it was so funny that he like had his eyes open to the technology.
That was in Florida.
Was it?
Yeah, I was on my phone telling him where to go. And he's like, nope. I was like, Dad, just listen to the thing. The robot. No, I was in San Diego one time with my father.
It says to go right. Michael, the water's on the right.
I was in San Diego with my father-in-law one time. Same type of thing. And we're not in Minnesota. We're in San Diego. He doesn't know where he's going. He doesn't know any of these roads. And he's like, no, the thing's wrong. And I'm like, it's not wrong. It's not wrong. And he was just like, I sat in the back. I was so frustrated. I was like, the thing knows what better than you do where we're driving in San Diego. But yeah, I found that fascinating in terms of like the technology history that I'm learning in this podcast of like when things happened and how fast things have moved since. It helps inform a lot of the thoughts around where we are going because the technology is moving so quickly.
I'm hard pressed to believe that when I'm 45 and Millie's 16, that there will not be a technology that I have that feeling that Dad had, that she has the feeling that you have.
Yep.
But I'm terrified as to how far advanced that technology is going to be. It's going to be what is the technology going to be that I'm like, I'm sticking with my iPhone.
I still remember my
Chips implanted in your arm. It like pumps up on you.
I remember I think it was my sophomore year of college. We came home and I was like, Dad, we got to do this thing called wireless internet. And we put wireless internet in the house. And he was like, what? Where's it coming from? How is it working on your computer? There's nothing plugged in. That's not, it's in the air.
It's the Wi-Fi.
It's wild. So it's amazing how fast it's all moved though.
That's very interesting. I have to listen to
the best podcast I've listened to.
After 7.5 hours of Google. After recording this podcast and then listening to this podcast, because I listened back because the information was so valuable. I'm going to listen to that podcast.
Love it.
Okay, let's get into it though. So there's been a lot of talk about the Fed. The Fed chairman, the Fed board, what they're saying, how that's affecting the markets and the rates. And mortgage rates have ticked down over the last, say, 10 days. Can you guys give us like a broad overview? One, what's happened in the last 10 days to cause that initial? And then we can talk about future insights. I believe jobs reports, ADP was at what, 55? The national one they came out with was 22,000. I think, yeah, both estimates were like 75. thousand jobs.
And they revised back again and on down again.
Q1 was revised down almost 1 million. Explain what that means, revised down. So the information comes in and there's, I mean, how we understand there's a lot of estimates that happen because they don't get all of the data in a clean fashion. I don't know why they haven't created software that.
So let's say this, right? Like if I had projected out, because I do the financials for our team, that we were going to make X amount of dollars as a team or sell X amount of houses. And every single month I said, we made that much. And then the next month I was like, just kidding, we made less.
That's what it is.
It's been happening every single month now. And in like 2 years.
Yeah, and the revision is fine if you're making an estimate. They don't really call it an estimate, it doesn't seem like, and then they do revise it. It is an estimate. But when the estimate is so far off from the actual, that's when people start to get kind of concerned.
And when the estimate is consistently going in the same direction, then there's something wrong with the process. That's just my 2 cents on that.
And so in this case, they came out with Q1 and said, we have this many jobs. There was quite a few. And now in Q3, when they're coming out, they're going, well, also in Q1, we really didn't have any jobs.
Yeah, also in Q2.
And in Q2. And I think, I talked to Alex about this. He actually had some really good insights on this thing.
Alex is a financial advisor. He's very rich, smart.
He said that, because he actually dives into the report itself. So he said that we might have another 200 to 400 drop on the government jobs because they fired so many people. Oh, sure, with the Doge stuff. They don't even know what the government jobs are. Hold on. That's not the revision. No. So here's the deal. So what happened is, and this is how he explained it to me, is he said they were all receiving severance. And so those job roles have not been rolled off yet. Oh. And so that had severance through a certain date. So in 2023, the government added 80,000 jobs. In year-to-date this year, they've lost 100,000 jobs. He thinks it's going to be 2 to 4. I said it's hard to know because they haven't released the info. But the total Fed employees right now is 2.9 million people. And he says it might drop another 200 to 400,000, but it's hard to know because they haven't released the information yet. I don't think they know because they use stone tablets to track the HR data is what he said. So that's the interesting thing, right? Because it wasn't actually the jobs they were even lost in that month, but the people stopped getting paid in that month. So then they counted as unemployed at that time. Because you cannot file for unemployment unless you are not getting. If you're receiving a severance package, you'll count as unemployed, which makes sense. You only get unemployment once you stop getting severance payments. Yes.
So whether or not the process itself is inherently broken, we have seen a lot of negative news surrounding jobs, both going back in time, but also just the last month when they got reported was a lot slower than we expected. And what that leads to is news or considerations that the economy is going in a different direction than was expected.
So we have less jobs. Yep. And then that would indicate that the economy is doing worse than expected.
Than we thought it was.
Well, and in simpler terms, kind of how I always explain this is when less people have jobs, less people have money, and less people can spend money. Exactly. And that's what leads to the jobs thing is a leading indicator on how much demand there is in a marketplace. And we're at 4.5% unemployment now. And we were historically they've been under. They like to keep it at 4. I think is kind of the number that the Fed shoots for. And we're over that now. Fun fact: what was unemployment during the Great Recession in the 2020s, 30s? 27%, 40%, 45%. Yeah. That's crazy though. 5 times more. One out of every 4 people that could work didn't have a job. Right now it's 1 out of 20, roughly 120, 1 out of 25. And so they're saying then, leading indicator that there's not many jobs had. The people don't have jobs, they don't have money, they don't spend the money. Inflation doesn't continue to increase.
Well, it's less about inflation and more about prioritization. So it's basically like when inflation is not where you want it to be, but the economy looks good, there's no reason to intervene, right? So they're not going to we're not going to pour fuel on the economy right now because the economy looks good and inflation's still higher than I want it to be. So let's just leave things alone. Now this indicators are saying, well, the economy might not be as good as you think it is, and inflation might actually not be as bad as we think it is. So maybe we are being a little bit too conservative with our approach to rates. I think everyone expected the quarter point once the first jobs report came out like a month plus ago. And now it's maybe even more like people are assuming 50 points are going to happen on the rate front. So when there's an assumption, we talk about this a lot of times, their future predicted. Yeah, when there's an assumption that the Fed funds rate is going to come down, it's impacting the bond market, which flows through the real estate market. and we see essentially a real estate market mortgage rate dip in advance of the actual changes in Fed funds.
So that was my next question. So based on all this, what's the expectation? The expectation is the Fed's going to have a 50 bip cut next time they meet on Monday.
Yeah. It's like, yep. We said, what, 60% chance is what
that's what I had seen. I had seen in the last couple of weeks. There is a 25% bet, at least there was last time I checked, on a 75 basis point cut, which would be really wild. Most people are betting 75 by the end of the year, which would put us right around 3% on the overnight rate. That would certainly drive rates down. We've seen compression on the 10-year to 30-year fixed rate spread. It's like currently sitting around 20 or 30 points. We saw that when the rates started rising, we saw that spread at 300 basis points. So when we had 4.5% on the 10-year, I don't think it went above 4.5 really, but we had rates at 7.5 at one point. Yeah. And now we're hovering around 4, but rates are sitting around the same for the quarter. So we've seen some compression in that marketplace too, which is good news for buyers and sellers, if I'm being honest. Just to see those rates kind of steady up. What's funny, I think, is we've talked about the data and how it's how they're collecting data, how they're doing data. I think that's something we've seen in our business where we're running. Part of our business is running a data company, basically. The amount of data we have is absolutely insane. The accuracy of data in the world where there's lots of it is sometimes hard to understand. Yeah. So, when you're seeing these inflation numbers come out and they're still sticking somewhere between 2.5% and 3% all the time, and then you go to a website like Trueflation, which is a really interesting website for those that have not gone to it. And they are just aggregating data across the internet to create a number. They're sitting at 2.03% for the United States economy right now. So what's right? What's wrong? What are they using? How do they know when they're making their assumptions off of jobs that we just said, then that end up getting revised anyhow? How much manipulation of the data can you do to try and get to the correct estimate?
Statistics, so you're changing your government structure in a way where you have fewer people doing the work. Is the process going to be able to be maintained? Is it going to get better? Is it going to get worse? How's that going to look?
And we all took statistics classes in college. Like the integrity of information is kind of the most important thing.
Absolutely.
And if you have integrity of the information, sometimes what ends up happening is you use the integrious, is that a word? Integrious? I think it sounds like a word. Yeah, it is. Yeah. You use this true information, right, that you have, but then you can spin it in any way that you want to and say, this is what caused this. So I want to do this now. Or your implicit bias lead you in a certain. Exactly. So it's really interesting to see all of that play out, and it's going to be interesting to see what they decide. And that's, the main reason why the Fed's supposed to be apolitical, right? Yep. So there's not that bias.
There's also the reality of the Fed chair's term and the fact that he's definitely not going to keep that job once his term ends. So you already are going to see whoever's coming in to become the next Fed chair is going to have pressure on them to lower rates. And those that are going to likely be nominated are ones that are likely going to push down rates. And so you're already going to have pressure coming down, and then there's going to be additional pressure coming down. So like we had a client that went under contract this weekend, and he was like, should I lock? Should I not lock? I'm like, all the pressure is going down, but in the next 30 days, I don't know. But in the next year, you're probably going to see markets looking down. So I would say pick a rate if you're comfortable with it, and then just keep an eye on where rates continue to move, because the movement seems like it's already come down quite a bit. We're at like 6.5, 6.25, a little above 6.25 right now. It seems like it's going to continue to shift in a downward direction. We'll probably clip that 6 range at some point here.
That is the question. What's the advice you are giving your buyers as far as what the future is going to look like? You're saying it's going to clip the 6 likely at some point. It's theoretical.
So I tell people it's like from a rate standpoint, don't make your decision necessarily based on rate. Make your decision based on when it's right for you. We talked about that a number of times. I think the market's going to be interesting. I know we may even have disagreements on this, where I think some of the economic stuff is maybe a little more concerning to me than it is to other people. We're seeing, as another conversation, like the number of home buyers versus home sellers nationally changed very drastically. Our market's a little more insulated from that. We've continued to see a pretty solid, stable market. But anything economic that starts to trickle back in continues to create more concerns in terms of, is the economy healthy enough? And are people going to get nervous because of some of those things? And even if rates come down, are we still going to see the same level of activity? At least through the end of this year, the hope would be that by the beginning part of next year, we start to understand where things are going, what the economy looks like. There's more certainty around things. And thus, if rates are going down and the economy is healthy, we'll see a very strong market at that point. So if I'm a buyer, and I'm encouraging buyers right now, I'm saying, if now feels like the right time for you, now is it? That's always how it is. You're right. Now is a good.
But if you're under contract right now and you're going, hey, 6.25 seems pretty good. Monday they're meeting. Theoretically, they could come out with a 25 bit cut on Monday.
That's a great. That's a go up.
I know. That's what I'm saying. And instead of 50, which the expectation, they come out with a 25. You didn't lock on Thursday or Friday this week. Now you'll 6.5. 6.5.
And based on my percentage chance of each, and based on the fact that the president is fighting with the head of the chair, that that chair really, really spiteful, and this side zero, you're kind of flipping a coin.
And if they do a 50-point cut, might just stay the same as it is right now. So if 6.5, 6.25 seems good, and that works for you, like you're saying, you maybe just lock it in and take what you can. I think 3/8 is the expectation right now, and they can't do that. But so if they get 50, you'll see rates come down. If you get 25, you'll see rates go up.
Right.
If you get 75, you'll see rates under 6%, probably, if I'm being honest.
I think you're probably right about that. Yeah.
Then the whole stock market will explode into action. The stock market will go, the S&P will be up probably 5 to 10% next week.
If that happens. Yeah. Which will be interesting. And so, but the question becomes like, who's making the decision, right, at the end of the day? Because Powell has been he's dug his heels in pretty good and said, like, I'm going to do what I need best. And I don't know. There's something about me that doesn't think he's going to shop the markets. He hasn't done it in no year.
He doesn't ultimately decide if the people decide. I think it'll be 50.
You know what I'm saying, right? Like he has tried to thread a needle of like, say this, do this, say this, do this. And like, kind of like, not go create any big reactions, right? His goal has been to minimize reaction. And so my hunch is they'll do 50 and it will keep the train going. I mean, the market will go up when they get 50, but he's not trying to shock it one way or the other.
We'll have to follow this up with one maybe in a couple weeks.
I think on the agent side of things, like now is a great time, especially like for our team. We work with a lot of buyers. 75% of our business is buyers. It's a great time if you're working with buyers to really get active. The rates,
especially first-time buyers that don't have to sell any.
Yes, the rates have significantly improved, and while at a time of the year which buyer demand tends to decline, so you're not seeing we are going to see buyer demand peak in the next 2 weeks for the rest of the year. It'll be the highest it will be from now to the end of the year in the next 2 weeks, and then it will trickle down all the way into the new year. So, and then the first week of January, it's going to be cast.
Especially if rates are low.
Especially if they're
what's interesting to note, and this is what I've noticed, I don't have like the quant on it, but the pace at which prices move compared to the pace at which rates impact payments creates these really interesting arbitrage windows. Where like when rates went way up, prices didn't just shoot way down right away, but payments shot up, right? And we've seen that. But when rates start moving down, all of a sudden you're like, oh, I saved $300 a month on my payment, but the price didn't. The price never just shot up to affect that. And so there's these windows where if there's negative downward rate momentum, especially during times in which the market supply and demand is kind of in a weird influx period, you have these opportunities to like make these buying windows where you're like, I was going to pay $2,500 a month. Now I'm only paying $2,200 a month. Nothing really changed in my process. It's just the market created this opportunity because the prices just never. They're so much stickier in big numbers versus payments that they don't shift in the same way.
And I'm a firm believer because I've had enough buyers and sellers at the end of the year try to sell their house in November and try to buy a house from November and December, not be able to buy a house and have to buy in Q1 of the next year, or not be able to sell their house and then list their house in Q1 of the next year. And you are better off selling your house in Q1, but always buying it in Q4.
100%.
I tell people, it's like, if you're going to look in Q4, I just want you to know your expectations that you buy a house in Q4. Because if you're looking in December and then you start again 2 weeks into January, the whole game is going to change.
Yep.
It's happened every year for 5 years. At this point, it's going to continue.
Absolutely.
I think so too. That's all we have this week on the Nerdy Agent Podcast. As always, remember, better